What is going on, everybody? And in this video, we're providing you a start of the market and stock picks for April 14th, 2023. So, if that sounds like something you're interested in, consider subscribing as we do provide daily and weekly updates to get you prepared for the day and the week ahead in this glorious market. So today we had an absolute tear coming in, which is funny. Let me actually drop this back up to the daily so you can see this a little bit clearer. The day has not quite ended. We got about 2 minutes on the shot clock for the remainder of the day. Now, tomorrow is going to be very, very important as tomorrow we have bank earnings. We have JPM, we have BlackRock, we have Citigroup, we have Wells Fargo, we have a lot of the big 10 banks in coming into tomorrow, and they'll be reporting at 8 a.m. Eastern Standard or first thing in the morning pre-market. So being said, we are going to get a lot of information today, and you can essentially say that today's pump was a pre-earnings run, right? You can even say that since roughly around the 38.15 back last month, about a month ago, we could have had our earnings run leading up into this. So again, things we are still in range, right? Our range can reach up to almost the 4200, but ultimately we need to break out over 4200 for this thing to really get any kind of legs. But again, the sentiment for the next 6 months is very, very uncertain. There's a lot of key indicators that are pointing for recession. One of them being that we had the PPI today came in really, really low. Again, all pointing to recession. Now, there's also the debate that any bad news is good news, essentially that the Fed will stop, that the Fed are essentially going to get a pause. And so that is what the market is anticipating is a pivot. But again, you have to understand pivot is great, but for the Fed to start laying off rates, you're going to have to get a major event for that to happen. And again, rates being so high and is the prolonged duration, of the rates being so high is causing a lot of problems and causing recession-like numbers. And we heard about a mild recession yesterday, and earnings are going to give us more insight into that. The earnings could potentially be pointing at a recession, and so that's kind of what we're watching is not only what the earnings are, but their projections. And we'll get a lot of that tomorrow morning with the banks, especially after our bank crisis. So there'll be a lot of eyes on the banks tomorrow morning when that does happen. And again, like I've always talked about, in anticipation, you always get a big spike before anything happens because, again, trying to soften if there's any kind of potential blow that could occur tomorrow. And then understand we're going to go full blown earnings mode next week. We've started earnings this week, but again, you have to get the bank earnings in first before you start to get the really impactful earnings. You have to have banks, and then you start getting your Netflix and Tesla next week. And then after that, then you start getting all your big tech, big industry leaders, your BA, Amazon, right? You get all those the following weeks after that. And then essentially the banks, you get about potentially like 2 weeks after the bank, so that encompasses your Teslas, your earnings, potentially 3 weeks, and Amazons and all that. All your big industry leaders are reporting within those 3 weeks, and then after that point, then the market's kind of decided where it wants to go after that, and whether that wants to continue running for another week and then start dying off. You have to understand this build up into this is essentially what would be deemed as a earnings run up. It can start a little bit out, like I've said. The market will try to get its earnings run in before actual earnings starts, and then if there is any kind of actual if there's any good that comes from the earnings, you can get another week or two push after that, and the market kind of adjusts, and then you get kind of a die off for 4 weeks after earnings. That's a typical normal cycle. And so, like I said, we've kind of got a little bit early, and then now we've kind of have a little bit additional pump here and a big pump going into tomorrow because of like I said, the huge anticipation of the banks and what's happening on there. Now, with that being said, it'll be interesting to watch because there has been a lot of money transferred over the when we got the SVB scare and the Credit Suisse scare. there was a lot of deposits into a lot of the Big Ten banks, and so tomorrow we might get a huge pump because of that. But again, uh, it's more so not that. I think it's more so looking for cracks, looking for failures, or some kind of weakness within the banks that people aren't telling us about right now. You have to understand there were bank stress tests that were done and they all passed with unemployment. I think they maxed out unemployment for that test at 6%, which is pretty much almost double what we have, or quote unquote, the national averages right now. Or maybe not as double, but pretty close to a double. So with that being said, again, things are in a really bad state, and we are really seeing like recession numbers. And so if we start seeing recession numbers in Q1, again, I think the worst of it you're going to see is potentially Q2 that we just started. So again, there's a very delayed reaction to a lot of these different things in the way they occur. So I think once you start, Q2 is really going to start exposing stuff and potentially get our catalyst that's going to essentially price in a recession. And once that's priced in, then you would have your bottom. So I think, again, the bottom is still yet to be seen. There's a lot of headline news saying the bottom was in. There's some random indicator that came out today in the news that's saying that, we're going to go into a complete bull market. Essentially, the guy that came on and spoke about this potential setup that he was talking about, he essentially null and voided everything else that had to do with bonds and gold or anything like that. It was just this technical setup. And technicals, if you follow me at all, I believe in technicals to an extent. I think it does play in, but again, more so supply and demand. I don't believe in wave theory or any of those other things. I think those things are very overrated. Again, just my opinion. I think supply and demand works great, but it works great with understanding events, right? And so that's the kind of trader I am. I mix technicals with events, and knowing what scheduled events are, knowing what the the market sentiment is extremely important, and knowing where it could potentially go and how it could potentially play out, I think is extremely important. And so I use a mix between the both, because not all technicals work out. And if there's an event, events can override technicals very easy, very quickly. And so this is why I incorporate a lot of events into the way I trade or the way I invest. So with that being said, again, tomorrow's going to be a big day and a big insight. So I know the weekly update in itself will be big because we'll have a lot of data, we'll have a lot of information tomorrow. But again, looking into banks, what I'm really looking at is for, again, over one, weakness, right? Things have already shown a lot of weakness. So it's more so looking at, is there going to be more layoffs announced tomorrow morning? That's another thing you got to keep in mind. Forward projection is going to be huge. They've already been talking about a mild recession and recession-like numbers. And I think there was a report today of one of the banks saying that, it's going to be a mild, not even a recession, but it's going to be, we're going to have a soft landing. I think someone reported a soft landing or something. I don't remember which bank it was. It wasn't any of the big ones from what I remember or recalling. But nonetheless, tomorrow will be very pivotal. And again, that will be before market opens. So tomorrow we could have a lot of volatility. Either way, it could actually cause us to break out and attempt to try to run to the 4,300. Like I said, if we do break out of the 42, that just puts us in the next range. It doesn't mean we're going back to all-time highs. In my opinion, you cannot, especially in a market like this, you cannot just assume we're going back to a full bull market. There's too many broken things to just assume that's what's going to happen. And things just been broken, right? And understand that the average consumer is skipping meals, right? And the debts and the defaults, you can't just wipe that under. That's not something like a year ago, people had money, people had savings, and you weren't talking about defaulting and all these other different other aspects. You're talking about high inflation, but at the time, people still had a lot of assets that they were selling off that they had accumulated over the pandemic to pay off high inflation, right? And then understand that that's essentially depleted savings. And so now you have to understand where the consumer is right now, where the demand is right now. is, again, this quantitative easing has put such stress on the consumer that they're skipping meals at this point. So to say that we're going to go back to a bull market, we're not there. Obviously, the Fed doesn't believe we're there because the Fed is still putting on rates, right? And there were some comments and stuff. I know good old Warren Buffett was on along the other day talking about where he thought essentially the recession was going and how Powell was acting, and how he's essentially tackling inflation. And he brought up Volcker, excuse me, from that whole debacle and some of the highest inflation we've ever had. I think it is actually the highest inflation we've actually ever had, or interest rates that have gone up to like 20%. But considering where we're at, considering where inflation is, and over the years, we're pretty close to Volcker numbers. If you account for inflation over the years, right? And so, just with all that being said, as of right now, that's not a good sign. We definitely don't want rates can't go up anymore. That's why I believe the Fed are incrementing 25 basis points at a time. And the more recession numbers we have, that percentage of a 25-point basis move is dropping. I think at this point, the June raise is potentially out of the question. May is debatable right now. I think what you're going to need, we're going to have a lot of major earnings before that next monetary policy. So before that next monetary policy comes out, you'll have more data. You'll have bank data. You'll have your industry leaders' data, their earnings, their projections, and then you go based off of that. And so if they're planning on laying off more people, again, I think there's still a very good chance for another 25-point basis move coming into May. But again, my projection for June is more so that we won't have one in June. I think by June we could hit a pause at that point. But then again, it all depends. If stuff starts breaking between now and then, again, you're in a very bad state. So all it would take was something to break. And things are under such stress right now. That's what I'm trying to point out here, depict here, is that things are under such stress right now. It could cause something to break, and then we wouldn't even need a May, right? And understand that at that point that maybe we don't even need a pause. I think because interest rates have been pushed up so rapidly, so fast, that you wouldn't even necessarily need a pause, that it would be more so something would break, and then it would be like, okay, well, we got to start cutting rates because now we've gone way too far. I think that's where we're at right now. And then the continued rate increases would essentially do that. And then ultimately understand you need a bigger collapse, like recession numbers, like the recessional numbers that are just starting to like show themselves, right? That they're going to get worse. And so again, we haven't even seen the impact of the last 25-point basis move, right? And understand where that's going to come, and that's why Q2 is going to be even worse. And so again, that data is again very, very delayed. So you have to understand that and understand where we were at, where we are now, and how long it took us to get to bank crisis. Right, it took us a year to get to a bank crisis on these rapid rates. So, with that being said, technical wise, that's kind of what I'm watching tomorrow. Again, the index will be followed by the SPX. Really, it was a pretty quiet day. I mean, there were some big movers today, but the rest of the market sat still and is anticipating for tomorrow. Bitcoin waiting. I think Bitcoin, again, not decoupled, I don't think, until we see what happens with the banks in this recession. Again, we see price in recession, it's not going to matter. People are going to pull out their money from everywhere. And the normal indicators are coming back, and the fact that gold is pushing. It's a concern. Bitcoin and gold are pushing. So Bitcoin's pushing up. Again, needs to break the 30. Like I said, going to push up to 40K closely to even get, if you're talking about, but this is on the monthly. You have to understand this is a monthly move that we're talking about. So depending where we end April will determine where that monthly candle is. As of right now, it can still push up to 35K, if not 40. But ultimately, it depends how we close out the month, right? And so, like I said, this could be a dead cat bounce. We'll see by the end of the month what Bitcoin looks like. Now, if we look over to gold, like I said, gold hasn't been this crazy. People thought gold was going to run up like crazy, but it's been running since November. It's had a massive push up and had a massive spike up, right? And so this is that I forget what this is called as far as candles, but this gap up and this star here is definitely an indicator that this thing is about ready to explode up. So we'll see. Yeah, and then this is gold on top of everything. So gold is ready to rock, and that's recessionary, right? People default to natural resources when it comes to recessionary periods, and so you're seeing that in gold and silver. Now Tesla, it's being beaten down, right? We got it and earnings is next week, right? So this, I guess, could be considered the earnings run. It falls in line with the market in general, but it just hasn't recovered, right? I think, and they had to slash prices too, so that's another big thing too. Their production numbers are down. They're slashing prices again. You got to look at what's actually happening, not just data sets, but what's actually happening, right? In the market, things are showing recession. So you have a lot of these recession indicators that happen, right? And you have the splits that happen, this was around summertime last year. You had a lot of splits happen, and so we are getting into recessionary. So these are all the indicators you need to watch, right? There's a reason why all your big companies did splits, right? You want to try to obtain more shares or essentially dilute your shares. So if there is a big move, it doesn't absolutely obliterate your company, right? And so this is why splits are done to dilute shares. So it makes it more stable at the higher rate than what it could potentially be once we go in a recession and this massive amount of selling that can occur. So Tesla right now, again, it's not looking great. This isn't really the Tesla you kind of see going in earnings. Normally it was up here or running even higher. But again, I've talked about this gap here. I think, and again, they have earnings next Wednesday, so we'll see what happens. But this thing could start pumping back up to 202 starting next week. Again, but it's all really dependent upon what happens tomorrow and with the banks. Again, the banks are going to set the pace, especially with the banking crisis just happening. BA again hasn't broken range. It's still sitting in the same range. So interesting to watch there. Now, JPM, something we talk about, a big day tomorrow. We'll see. Again, if it shows weakness, forward guidance, or all those things we're watching. Again, this is the biggest bank, right? If this shows weakness, this could be a huge downfall. And I'm still looking for this thing to gap fill, just like Tesla. So we'll see. It needs to hold roughly the 122. If it can't, it's going to do this gap fill down to the 109. And so this is what we're kind of watching. And it's the upside. You have the 135 and then potentially the 143. Again, if there's any upside, you'll get a little bit of a pump, in my opinion. But I think that's very that could potentially, like I said, push us on the general index into that 4,300 range, and then that's another about 100 points we could run. But again, we're not out of this yet, right? Like we still have recession. Now you go from one stage to the next stage to the next. And this is how you get out of this this bubble that we're coming from, and understand that it's a slow process, that you have different stages you have to go through. It's not just one and done, we price it in, now we're running back to all-time highs. That's not the way it works. It needs to price in, it needs to normalize. And this normalization of bringing down prices to where they should be, and not have, you don't want these high prices. Like, you have to understand that greed has pushed these prices up so high. People are price gouging on cars and houses and all these other these essential almost necessities that one would need to just live their normal everyday life, or absolutely absurd. Nobody wants to keep paying high prices like that. But for you to not pay high prices, you need down cycles. You need these cycles to normalize. You need a lot of stuff to get crushed. And a lot of these, these companies with malicious intent, or whatever the case is, a lot of loss of words right now. But ultimately, these fake companies or just riding the wave in the bubble, right? They all need to crash and need to go away. And the companies that are actually trying to make a lasting impression that they're still around and survive during times like this is why these times are needed and necessary, to essentially flush out a lot of the garbage that's out there. So with that being said, we will wait and see. We'll see what tomorrow brings. And again, I think the weekly update's we're gonna get a good pace of understanding what to expect in the next earnings, where we could be sitting at uh, when this final stage that I'm talking about, as far as a potential crash or pricing in a recession, right? I think all that we're going to start getting insights into that tomorrow. Tomorrow is going to be the start of everything. In my opinion, like I said, earnings has already started, but this, in my opinion, is what's going to set the pace. And that's to understand where the banks are currently sitting, what they're projecting. If they start mentioning a lot about recession, that is going to be a big concern. So just again, these calls when the CEOs are talking, going to be very, very, very insightful tomorrow. And then not only understand as soon as that they've come out with their earnings statements and their calls, right? They're going to go on to Bloomberg and they're going to go on to all these other media outlets and start talking about it as well. So just be mindful of that. So tomorrow's going to be extremely volatile. So again, just be highly keep that in mind, and then we take it from there. So if you made this far, I do appreciate you. Go ahead and drop a like. And until next time, I'll see you guys later.